Good evening. This message is going out to all subscribers. It is Monday night, October 13th, about 8 o'clock Central Time. I just wanted to do some market analysis and to talk a little bit about selling out of the money put credit spreads. If you're not familiar with what credit spreads are and the risks and rewards, I suggest getting a book. It's a very, very effective strategy, especially when option implied volatilities are elevated as they are now. So we have the market breakout fails, we start to roll over, we break the 100-day moving average. In fact, we barely poke above it before falling, and now we've fallen below the 200-day moving average. Holy cow, where do we go from here? I'm going to take those moving averages back off, and we're going to zoom out. This will allow me to use a Fibonacci tool. I'm going to put it right at the top here, and I'm going to bring it down to the last prior low right there, and that's going to give us an idea. So we've just made the first target level, and now the next target level would be this 184 support level. So we could conceivably fall to SPY 184. This is very, very extreme. I'm going to take the study off right now. Right click, remove drawings. This has been very, very extreme selling. We haven't seen anything like that in quite a while. But you can also see, I'll pop up the trend lines using the trend line tools. There's the 200-day trend line. There's the 120-day trend line. Both have been breached. So we've got some pretty severe technical damage. What does that mean? Well, we're going to take a look at previous capitulation lows, and you can see that they were very, very, very brief. And then whoosh, we'd run back up. Very brief, run back up. Very brief, run back up. This one is going to take a while to form a bottom because this is natural selling pressure. Look at the big volume. This is not just bullish speculators being flushed out. There is some bona fide selling taking place. There are worries about Europe's economic growth. There are worries about Ebola right now. So we're going to zoom back in, and we can expect to see choppiness at least for a while. But right now, we do want to take advantage of the higher than normal option implied volatilities. I'm going to type in SPY. And when I start typing on the screen, this little box comes up. And I'm going to put in VXX so that we can overlay. And there we can see, as the market declines, option implied volatilities skyrocket. So we'd like to sell that expensive option premium. If you went out and bought calls right now, you would be paying through the nose for them. Same thing with puts. They're juiced with option implied volatility. I'm going to take that study down. Actually, before I do that, I'm going to zoom out so you can see on a relative basis. This is 1 year chart of implied volatility, and you can see how it's continued to slip. So we aren't near the peak that we saw last January on that trough right there. And that might have been debt ceiling related, where we just had that little bit of a free fall, but that came right back in very quickly, and now they've been near historic lows, but we're getting this jump up. So we probably still have a little bit more room to go on it, but this is the time that you want to start thinking about selling that premium, because just like here, once the market starts to reverse, those option premiums collapse instantly. So that's where you want to be selling that premium. Plus, you can distance yourself from the action and let the market chop around, find its footing, and not have to worry about every wiggle and jiggle. So now I am going to take that off. I'll just enter SPY and it'll remove it. So we know that we could conceivably fall to 184 before we find a support level. That's about 30 S&P points. Pretty nasty stuff. So I would like to start lining up some put credit spreads. And so I thought I would just bring up high flyers and go through and click on them, because I've been mentioning selling out of the money put credit spreads. and I'll show you this symbol group. So what we need to have is we need to have a buy signal, okay? Well, we don't have a buy signal. We've got a sell signal, so that's no good. Even if we had a buy signal, we have to have some horizontal support to lean on, okay? So right here at this 205 level, that was horizontal support. Now it's horizontal resistance. We need to get back above this on a buy signal before I want to start thinking about selling some out of the money puts, okay? And then our stop would be very easy to determine, 205, because that's our horizontal support level. Here we've got a 100-day moving average. That I wouldn't mind leaning on if the stock had come down like this and had based around for a while on that 100-day moving average and now is starting to move up with a buy signal. That wouldn't be so bad, but we don't have that here. We're starting to get into a little bit of a waterfall situation where, who knows, LinkedIn, internet stock, whoosh, it could fall down to 160. We don't want to be credit spreading on this until we see that support, a nice rally up above that horizontal support line on a buy signal. Then we can feel a little bit more confident because we know that buyers have been coming in. Let's go to the next one, Netflix. I'll temporarily leave the 100-day moving average up. But here we do have a little bit of a horizontal support level right in here around that 440 level. So we need to have a buy signal first and foremost. We do not. We've been short since up here, which incidentally, I hope some of you are on this trade because it has been a good one. We also caught an awesome buy right back in there. So that's our horizontal support. We need a buy signal. We need to be above it. Then we can start thinking about selling a 440, 430, or 435 put credit spread. Our stop would be right there. Stock rebounds above it. We're expecting it to continue higher. Again, we're trying to take advantage of those inflated option premiums. Here we have Tesla. Got our sell signal right there. We've got a big breach through horizontal support here, which this is significant because this was a breakout right here. So draw a line across, that should be support. Lo and behold, it does find support there briefly and bounces, but now, whoosh, it's cracked right through. So that would be my first level at 240. I'm going to put up a 100-day moving average, and guess what? We're right at that same level. So we need to see Tesla above 240 on a buy signal before we even contemplate selling it out of the money put credit spread. And we'll use that 40 strike price, and we'll try and go out as far as we can. This has high option implied volatility, so maybe you can sell a 230, 225 put spread and get a decent credit for it. You'd be using that horizontal support and that moving average as your stop. WellPoint has been actually holding up pretty well relative to the overall market. Here we've got a natural horizontal support level right here because this was a breakout to a new high. That, you can see if we go just a little bit higher in here, was horizontal support, touch, 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 touch. So 117 was our horizontal support there. We need to see it above 117 on a buy signal, and then we can feel pretty good about selling that put spread. Maybe a 115, 110 put spread. You also know that you're pretty close to that 100-day moving average, so if some bad news hit the stock, you could stop yourself out there. One word on credit spreads. Never have a credit spread over earnings. The reason for that is that you don't know what's going to happen, and you don't want to be collecting $1 and risking $4 on an earnings announcement. So I like to sell credit spreads right after earnings, but I don't like to hold those credit spreads or even long options over earnings. The system will let you know when you need to get out. Very steep decline, okay? Because the stock has been down so much, it's actually starting to form support at the $60 level, and it just recently broke down. So here we would need to see a rally above 60, on a buy signal, and then you could sell the 60.55. Now, I wouldn't be crazy about this pick just because it's been so weak before this market decline even started that I'd like to see it base just a little bit longer. It'd give me a little more assurance that the time is right. Under Armour held really strong until just 3 days ago. So it was holding that breakout. Now it's filled that breakout in, okay? Filled in that gap. That would be a support level that you might be able to lean on, but the problem is we've broken this horizontal support and we haven't formed any kind of base, nothing to hang our hat on yet. So right at this $66 level, I'd like to see it on a buy signal, and I'd like to see it rally above 66. Then we also know we've got the 100-day moving average right here at 63.60. So we might be able to sell a 65.60 put credit spread. If the stock comes down here and the market waffles around and it starts to form a base in here, and then we get a buy signal, and this horizontal support right here holds at the $60 level, I'd feel pretty comfortable selling an Under Armour 60.55 put credit spread. But you can see that we're about $6 away from that. So if it came down and tested that 100-day moving average, we know they've got that support level there. I'd want to see it at least rest for a few days to tell me that buyers want to get in here. I got to have something to, like I say, hang my hat on. Right now, I'm not seeing that, and we've dropped all the way down through here. So $60, you got to start forming a base for at least a week, and then you get a buy signal and you get a little follow through. Then I'm good with it down here. Otherwise, that would be my choice right in there. So that's just some information on how to trade put credit spreads. We haven't seen an option implied volatility spike since February. That was very, very brief when it did happen. Otherwise, because of the Fed, the market's been grinding higher, and option implied volatilities have been very, very cheap. So we want to take advantage of this opportunity. I know that Europe's economic conditions are faltering, but they have been faltering for quite a while. In 2015, if they continue to slip, could become a credit crisis. So we do have to be mindful of it. We've got to watch out for it. I think that Ebola right now is striking a nerve with investors, and everybody's starting to sell their holdings. But this free fall the last 3 days, we've fallen about 100 S&P points. It has almost a liquidation feel to it. It feels like margin calls might be forcing people to liquidate. So these tend to end very quickly with very, very sharp reversals, kind of like what we saw here, where, oh my God, the market's really falling apart, and the next day you get a 300-point Dow rally. So if you are long puts here, we've had an excellent run. Protect your profits here, okay? Don't let one of these days strip all of this away. So as the market continues to sell off and as it continues to fall, take some off. If you've got a 10 contract position, sell 2. Maybe you sell 3. I guarantee you, if you do that, the remaining 7 options will be so much easier to trade and to manage, because you'll know you've already banked some profits. You're never going to pick the absolute top. You're never going to pick the absolute bottom. So just taking profits along the way will really help you, especially if you get a couple of these back to back. Oh my gosh, you'll be happy you did. And I'm going to reverse back, and we'll take a look at a couple of those. So your long puts, let's go back to January. Your long puts in here, you're so happy. Oh my gosh, look at the market fall apart. I am making serious money now. Well, you get one of these, and if you wait another day or two, you've just given everything back. Don't let that happen to you. So we are entering earnings season. The end of October, beginning of November is seasonally very bullish. So you'll have seasonality working against you, and earnings season should stabilize the market. I think earnings are going to be pretty decent, and that'll take some of the focus off of Europe and Ebola. So please consider a platform subscription. During these wacky markets, I've been using the pop-up messaging to send messages to everybody intraday. Plus, in the platform, Market View, I post my market comments every day before the open. They'll really help you assess what's going on. They'll help you set some targets, where to get in, where to get out, what types of strategies I'm considering, how I see the day unfolding. If this happens, then expect this. Those comments are worth the $60 per quarter. And there's also a scanner. I'm going to click on that. I recently offered it for $40. It's normally $100. That's per quarter, and it gives you access to these searches right here. So if you're looking for opportunities, I'm going to click on bearish reversals. So we're looking for stocks that are going down, and we'll look at breakdowns. If you have the 3,000 symbol subscription, I'm just going to start clicking. Price line. Look at where we're short price line. You'll see some beautiful declines along the way here. So if you're looking for trading opportunities, the scanner will definitely help you find them. And if you got the 3,000 symbols, you'll be able to quickly identify breakdowns like that and then the sell signal and be all over that the day that the sell signal comes out. Thank you. I hope this video helps you make money.